Welcome to our webinar, Tax and Treasury, It Takes Two to Tango. For the next hour, we're going to talk with different specialists about how tax is affecting your treasury operations and your treasury setup. My name is Laurette Temmerman.
And my name is Richard Roering, and together with Laurette, the moderator for this webinar. Also, from my side, thank you very much for connecting with us on this topic. Let us first introduce the speakers of today to you, who will be sharing their view and expertise on transfer pricing related to financial transactions. First of all, we have from Zanders, we have Melanie Beirens. Melanie focuses mainly on transfer pricing solutions for financial transactions. From A.S. Watson, we have Barry Ketelaar. Barry is Group Controller Europe for A.S. Watson. A.S. Watson, known for its labels Ici Paris, Kruidvat and Trekpleister. And last but not least, from Quantera Global, we have Stefan Ubachs and Adriaan van der Heijden. Both gentlemen are transfer pricing specialists.
And who is joining our webinar today? Based on your registration, we know that almost 40% of you is working in tax. Nearly 50% is working in treasury and 30% is having another profession. And you're active in all kinds of different industries. Also a practical point. During this webinar, you can submit your questions. You can use the private chat box for this and at the right-hand side of your screen. And at the end of the webinar, we will come back to your questions. And to make it a bit more interactive, we will also ask you some poll questions during this webinar.
As said, today's topic is about transfer pricing related to financial transactions. Also, cash pool techniques and in-house bank setups are impacted by tax. Next to the fact that ING offers those cash pool products, we would also like to support our clients in sharing best practices related to transfer pricing matters for cash pools and intercompany loans.
And that's what we're going to talk about today. So let's start with our first guest. Stefan. Hi, Stefan. Stefan, can you give us a bit more insight on what has changed regarding the tax treatment of cash pooling and intercompany funding?
Yes, certainly. Hi, Laurette, Richard. Thank you very much, and good to be joining this webinar this morning. Let us first look back. Before 2015, it was relatively easy for multinationals to make use of the various loopholes in the tax systems and also to artificially shift profits from high tax to low taxed jurisdictions or even to no taxed jurisdictions. What you could say is that the financial crisis of 2008 was a wake-up call for governments, also from a tax perspective. As we all know, globalization has many benefits, but what it also did is that it facilitated tax evasion and tax avoidance. So what countries did is they started to realize that it was really necessary to work together on a global basis in order to close the loopholes and to make sure that everybody was paying its fair share of taxes. And this resulted in the fact that in 2015, the inclusive framework on base erosion and profit shifting, also called BEPS, was established. And what BEPS does is that it brings together over 135 countries and jurisdictions that collaborate on the implementation of measures to tackle tax avoidance and also improve the coherence of international tax rules and ensure, therefore, a more transparent tax environment. And what is also a very important development is that in February 2020, the OECD published for the first time specific guidance on the transfer pricing aspects of financial transactions, such as intercompany loans, cash pools, financial guarantees, and captive insurance. And this new OECD guidance affects the transfer pricing legislation in most jurisdictions and is a clear signal that financial transactions gained increased interest both from an OECD and a tax authorities perspective.
Okay, thank you, Stefan. And what is exactly the consequence of the publication of the OECD guidance on financial transactions?
Well, Richard, after the attention by tax authorities for the on-charging of costs by group companies, tax administrations had increased attention for the EBIT level of group companies. And what we now see after the new attention for the OECD guidance on financial transactions is that tax authorities also scrutinize interest charges more closely. So what you could say is that transfer pricing is really climbing down the P&L in recent years. Tax authorities are using the OECD transfer pricing guidelines in order to look more closely into financial structures like cash pools and in-house bank setups in order to see whether all transactions are indeed at arm's length. What the tax administration will do is that they will scrutinize transactions if they believe that their jurisdiction unlawfully misses out on certain tax revenues. Each country and each jurisdiction wants to have its fair share of that entire pie of tax revenue. And if tax revenue is generated in a certain country, at least according to the tax authorities of that country, then what they want to achieve is that that revenue is also taxed in that country.
Okay, thank you. And what are the main components that tax authorities are assessing when it comes to intercompany financing?
Well, there are three main components that tax authorities are looking at. First of all, the business rationale of a loan. Second, the terms and conditions of the loan. And thirdly, the substance of intra-group financing entities. And when we look at the first component, you see that in assessing the business rationale of a loan, the tax authorities will analyze what a third-party lender and the third-party borrower would have done in a similar situation. What you have to do is that you have to apply a two-sided approach. So you have to look at the perspective of the borrower and also at the perspective of the lender. The question you have to ask yourself is whether the borrower could have gotten a similar loan from a third party, and also if so, whether the borrower indeed would have entered into that loan or not. And if your answer to one of these two questions is no, then it is likely that the tax authorities will also say that there is no business rationale for the loan. And in that case, the loan will not be accepted as such for tax purposes. The second component that the tax authorities will assess are the conditions of the loan. And of the conditions of the loan, obviously the interest rate that is applied is a key attention point. In assessing the arm's length nature of interests, what tax authorities do is that they, amongst others, take the credit rating into account. This includes the credit rating of the borrowing entity on a standalone basis, but also the credit rating of the multinational group as a whole. What is also taken into account is the position of the borrowing entity within the group, and whether there is so-called implicit support. And what implicit support means is that whether a borrower would be able to benefit from better loan conditions than on a purely standalone basis, just because of the fact that it is part of that multinational group. And this implicit support is also taken into account by tax authorities in an intercompany situation.
Okay, thank you, Stefan. Talking about the implicit support, can you give an example of what an implicit support can do for a rating?
Yeah, sure. So, for example, if the standalone rating of a group company is, for example, BBB, and the rating of the parent company of that group is single A, that means that the credit rating of the borrower will, for tax purposes, somewhere between the standalone rating of the borrower and the rating of the parent company, if there is implicit support. What you should also take into account is that, contrary to an explicit guarantee, an implicit guarantee is not considered as a service for transfer pricing purposes. So it is not to be remunerated separately, but it is, however, taken into account in determining the interest rate for tax purposes.
Okay, thank you. And the third point, the substance you were talking about, substance and tax havens, that's also quite often in the news. Can you elaborate a bit more on that?
Yes, yeah, it is a hot topic, Laurette, and tax authorities indeed also pay more attention to substance of intra-group financing entities. What you saw in the past is that many multinational corporations made use of intra-group financing entities that did not have real substance. And with substance, we mean that an entity should avail of sufficient capable employees to carry out their financing activities. And these employees should also be able to control the risks related with that financing. And a letterbox company in a sunny tax haven, while the actual decision taking in respect of those financing activities takes place elsewhere, that is something that simply doesn't work anymore.
Okay. And what actions do you see in practice taken by corporates to fulfill the substance requirement?
What we see is that more and more groups relocate their treasury activities to their head offices, as there is normally sufficient substance at the head office location. What you also see is that many multinational corporations are restructuring their intercompany financial service activities and do no longer use entities in typical tax havens like the British Virgin Islands, the Cayman Islands, or Bermuda. So financial transactions that used to be structured through cash box companies in these countries are now more and more structured through onshore entities. We call that a bit jokingly the bounty test. So if the location in which the company is located is fit for a bounty commercial, well, then it may well be located in a tax haven, So from a transfer pricing point of view, there may not be sufficient substance in that case.
Okay. Well, in the Netherlands, summer has arrived, but we still don't see many palm trees. However, the Netherlands is quite often perceived as being a tax haven. How do you look at the Netherlands in this respect?
Yeah, well, there was recently a newspaper article, Laurette, on Viacom, in which that discussion also came up. But the Netherlands is certainly not a tax haven. Yes, the Netherlands has a very good business climate for multinational companies, but it is not the same as a tax haven. And the same is true for other EU countries, like Luxembourg, for example. Every Dutch taxpayer has to pay its fair share of taxes in line with the functions it performs and the risks that are borne by that company. And the same is also true for companies located in other EU countries. And what is also important to mention is that the EU has expanded its anti-abuse legislation in that respect. So the Netherlands and other EU countries are nowhere near a typical tax haven.
So the Netherlands is here to stay?
Yes, definitely.
Good tip.
All right. So you talked about the three main components which tax authorities assess, being the business rationale, being the terms and conditions, being the substance requirement. What if the tax authorities are saying this transaction is not at arm's length? What will happen then?
In that case, Richard, you are facing several risks. Let me explain that in more detail. First of all, it is possible that the tax authorities will not accept the loan as a real loan for tax purposes, as stated on the left side of the slide. And if your financial instrument has actually more characteristics of equity instead of debt, then the tax authorities could requalify that loan into equity. And such requalification will lead to tax consequences that are completely different than intended by the group. What is also important to mention is when you have a loan, the interest that is paid on that loan is normally deductible from the borrower's profits. However, if the financial instrument is requalified into equity, that also means that the payment that is made by the borrower is also requalified. And in that case, those payments are dividend payments instead of interest payments. And dividend payments are normally not deductible for tax purposes. So you can imagine that this can have major consequences for the taxable profits of the borrower.
Okay. And what happens if a loan indeed also qualifies as a loan for tax purposes? What happens then?
In that case, the tax authorities will assess whether the conditions of the loan are at arm's length. And if that is not the case, what they will do is that they will adjust the interest rate of the loan to an arm's length level, as you can see on the right-hand side of the slide. And if the tax authorities believe that the initial interest rate was too high, they will disallow deduction of the part of the interest amount that they consider as excessive. As a group, you will then have to try to get a so-called corresponding adjustment in the jurisdiction of the lender. And if not, you will face double taxation, which is something that you do not want. And if the tax authorities in the borrower's country apply a correction for multiple years on a high interest amount, the impact can be quite significant. But even if the tax authorities in the lender's jurisdiction would be willing to reduce the taxable interest income, you could still have a negative impact if there is a difference in the tax rates that are applied in those two countries.
Okay. Thank you, Stefan. Before we go to discuss further, we first have a poll question for our audience. The poll question will pop up at the bottom of your screen, and there you can also submit your questions. Well, the first poll question is as follows. We have a clear and well-documented transfer pricing policy for our intercompany transactions. Yes, no, don't know.
Okay, so let's wait for a while before we will publish the results. So stay tuned. Now we will move on to the next speaker. That will be Adrian. Hi, Adrian. Welcome.
Good morning.
Good morning. Can you provide a bit more insight in how cash pooling is treated in this respect?
Yeah, sure. Thank you for the question, Richard. Let me first briefly explain the transfer pricing challenges that you may face regarding cash pooling arrangements. And then I will discuss the consequences if tax authorities do not consider transactions to be at arm's length. So first of all, cash pooling is the pooling of cash balances as part of a short-term liquidity management arrangement. So basically, short-term is key here. So one of the main risks is that a long-term position is requalified as a loan transaction. So as a consequence, the applied short-term cash pool interest rate is not considered to be at arm's length, and a higher interest rate should then be applied based on the requalified long-term transaction.
And how can a corporate determine if a position is indeed short-term?
Yeah, that's a topic a lot of multinationals struggle with. So is it when you have a specific debit or credit position within the cash pool for over a year? But what if you have the same position in the cash pool for 51 weeks, for example, but the other week the position fluctuates? Or do you then have a short-term position? Where do you draw the line? In general, this is not a simple question to answer and really depends on the facts and circumstances of the specific cash pool arrangement and the specific companies involved. Furthermore, some countries may also have their own interpretation on long-term positions within a cash pool. To give the attendees a rule of thumb, in general, that is a position longer than 12 months can be considered to be a long-term position. So that does not mean, however, if a position longer than 12 months is artificially reduced with, for example, 1 or 2 days in order to meet the short-term qualification, that you're fine. So that's something that also may be challenged. So it's important to consider the facts and circumstances and to not artificially reduce your positions within the cash pool. This is something also we expect to see increased discussions with tax authorities in the coming years. This may become a very important attention point for them as well.
Okay. And what happens if everything is okay and the transaction indeed can be qualified as a short-term cash pool facility?
Yeah, if the transaction indeed can be qualified as short-term cash pool facility, then the second question arises. So what should the remuneration be for the cash pool leader and the cash pool participants, basically? First of all, you have to perform a functional analysis on the cash pool leader where the specific functions performed, assets used, and risks assumed by the cash pool leader and the cash pool participants are determined. Basically, there are two extremes. The most common one is where the cash pool leader performs a more coordination or agency function. So the activities performed and risks assumed by the cash pool leader are then rather limited. So that's basically the picture on the left side. Given such a low level of functionality, the cash pool's leader's remuneration as a service provider will generally also be limited. And the alternative, so the picture on the right side, is where the cash pool leader is also involved in more strategic decision making, cash management for the group, and is, for example, also responsible for raising finance across the group by issuing bonds or borrowing from third-party banks. Obviously, due to the increased functionality and risk borne by the cash pool leader, the remuneration of this company will generally also be higher than the remuneration of a coordinated cash pool leader. So that are basically the two extremes. But then you also have the cash pool participants. Cash pool participants should also benefit from the cash pooling transaction and should be allocated some of the benefits of the facility. If a tax authority may challenge the overall remuneration of either a cash pool participant or a cash pool leader, the result is in line with what Stefan just told us. So the tax authorities may adjust the interest rates applied, but also the specific results of, for example, the cash pool leader may be challenged. As a final note, I would like to mention that cash pooling is a difficult topic. So not only for multinational, but also for tax authorities. That makes it even more important for a taxpayer to have proper transfer pricing documentation in place, where you basically document what you do today for discussions with the tax authorities in the future. This significantly reduces the risk of being challenged by a tax authority.
Okay, and what steps should a corporate take to indeed stay in control of his intercompany transactions?
Yeah, as the title of our webinar already suggests, it takes two to tango. So the first step would be to get in contact with your colleague treasurer or tax manager to discuss any existing in-house bank structures and intercompany financial transactions. This seems like a no-brainer, but in our experience, there are a lot of multinationals that are involved in significant financial transactions with limited substantiation on the arm's length terms and conditions and interest rates. So with the new OECD guidance on financial transactions published last year, there's an increased attention by tax authorities on financial transactions. So old-fashioned tax defense lines may not be sufficient anymore. And it is well advised to re-evaluate your existing TP transfer pricing exposures and take appropriate measures. That being said, in general, there's a 5-step approach towards being in control over your intercompany financial transactions, so which you can see also on the slide. So the qualification of the financial instrument, determining the credit rating and analyzing the loan conditions, determining the arm's length interest rate, making the right documentation, and setting up the right monitoring process. Later on, Melanie from Zanders will give you more background on the practical implications of these aspects.
Okay, thank you, Adrian. Stay with us because we have the first results of our first poll question, which was, we have a clear and well-documented transfer pricing policy for our intercompany financial transactions. 73% answered this question with yes, we have a clear and well-documented transfer pricing policy. 21% said no, 6% don't know. What is your first comment on this, Adrian?
To be honest, I did not expect this outcome. We see a lot of companies struggling with this topic, and most of them also have some catching up to do. But yeah, obviously it's good to see that a large part of our attendees are already well prepared. For the companies that do not have proper documentation in place, be assured that there are a lot of multinationals struggling with this topic. So you're not too late.
That's good.
Right.
Okay. Well, we can expect that all the changes in tax rules and regulations is really having an impact on the way tax and treasury is working together. And before we go into discuss this further with Barry, we first have a poll question for our audience, the second one. And the question is as follows. Determining the arm's length interest rates is the responsibility of treasury. Yes, no, don't know.
Barry, welcome to our webinar.
Good morning.
Good morning. What would be your answer to this question?
Now, let me first of all thank you, Laurette and Richard, for inviting me to this webinar. Always nice to share some practical details on these kind of topics. Coming back to your question, in my opinion, this still is the ultimate responsibility of the Treasury team. They are, in the end, they need to assure the funding, and the interest rate is actually only one component of that. But they for sure cannot do this without any proper cooperation with and consulting with the tax team. Really, the time where treasury and tax were two separate kingdoms, that's long gone, and cooperation must take place, and it actually must take place before the actual deal or transaction is closed. So this is also the reason that 2 years ago within A.S. Watson Benelux that we integrated the tax, the treasury and the reporting team into one department. This really facilitates the interaction, the understanding and the cooperation between the three.
Okay. Yeah, you're saying, hey, you've integrated tax, treasury, reporting in one department, but what has really changed in the way that you're working together?
Yes, from my point of view, in the past, the key focus of the tax department was a timely, complete and accurate submission of the standard items, personal income taxes, VAT, corporate income taxes. But the last years, that really has changed and it shifted to much more focus on complying with all kinds of transfer pricing requirements. You already mentioned BEPS, the local files, the master files, CBCR requirements, tax control frameworks, etc. And actually, the practical consequence of this is that we have more frequent and more detailed reporting requirements on transactions between group companies. And that's from buying transactions to services provided to intercompany loans. And this all requires that we have a close cooperation between the tax team, the treasury team and the reporting team. Tax needs to understand what's happening in the business and treasury needs to understand the tax requirements. This is, in my opinion, crucial in order to understand and document the business rationale for any deal or transaction made.
And what have you noticed from the fact that the tax authorities are paying more attention to the group financing transactions?
Now, actually, a bit in line with what Adrian and Stefan from Contera already mentioned, the focus of tax authorities really has shifted in the direction of transfer pricing and group transactions. Also on our end at A.S. Watson, we recently experienced that in establishing a new guarantee fee on our external loans, which also included the element of implicit support. And the focus of the tax authorities in these kind of topics, and especially the guarantee fee, was huge. And it actually requires that you take care of the following elements. First, you need to have full loan documentation in place, including the business rationale of having the loan. Second, you need to perform a loan pricing analysis. And that consists of the credit rating analysis, where you actually include quantitative factors, like the credit rating of the borrower and the lender. But you also look at the qualitative factors, like the development of the market, competition, and, as mentioned earlier, include implicit support argumentation. Now, once you have done that, the next thing is that you perform an interest rate benchmarking study in which you actually use the loan amount, the duration, the currency, the credit ratings, and that results in the end that you get a range of interest rates where you can pick from, being the lower, the median or the upper quartile. What's another good angle to mention is that you need to be aware of the OECD's multiple angle approach, which was stated in the recent 2020 report, where the OECD mentioned that you need to look at multiple approaches. And that's not only the benefit approach, which is mostly commonly used now and probably also mostly preferred for your organization, but you also must look at the cost approach, which might be the tax authority's favorite. Assuming you as an organization will want a higher deductible interest cost in the Netherlands, the latest OECD guidelines, which luckily for all of us is not yet followed by the Dutch TA, will actually request you to check both approaches, which then most likely will lead to a lower accepted interest rate. In all, and in short, our experience is that you need to document what you are doing today for discussions with the tax authorities in the future. Simply have your documentation in place.
And what have you planned as your next steps, Barry?
Yeah, there are certainly next steps to take because we're not ready yet. The next thing after our major financing, including the guarantee from our mother company, we will now do the same analysis and documentation for all our intercompany loans, from our Dutch mother company to our European subsidiaries. And for this, we have started using the Xander solution, which Melanie in a few moments will discuss in more detail. Next step after that will be that we also start looking at the current account positions for entities included in the international cash pool structures. Interest gain or interest cost to be charged.
Thank you, Barry. Before we're going to discuss further, let's see if the audience agrees with you. The results of the poll are coming in. If it indeed lies with Treasury determining the arm's length interest rates, or that they think that it lies with tax. I think it was a difficult question because, or maybe a close one, because we don't have the results yet here. We can ask Melanie what she thought, or what her opinion is in this, what she expects the outcome to be. She doesn't have the answers and we also don't have them yet. Maybe we can get Melanie?
Yeah, sure. Hi, good morning.
Hello.
Yeah, well, what we mostly see is that it's actually very diverse. So in some companies, it's really the responsibility of tax. In others, it's the responsibility of Treasury. And then you have, of course, the difference between do they do that in close cooperation or not? What we usually see that works best, and what we as a consultant prefer, when there's really a close cooperation and between Treasury and tax on this.
Okay.
I think we have a small technical problem, so let's continue, and the results will be shown later on. I think we also have another poll question to come up, which is, do you have an automated process in place to efficiently price and document financial transactions? Yes, we have an end-to-end solution. We have tooling in place for some aspects, but still require a lot of manual work. No tooling in place. Please choose your answer and stay tuned. We will come back with the results later on. Okay, Melanie, let's continue. While our viewers are taking the time to answer this question, can you give us some insight to what you usually see at clients?
Sure. So in general, what we see is that there is a very small number of really end-to-end solution providers in the market. And what we mostly see is either it's being done on a loan-by-loan basis by external consultants at the analysis, or otherwise, solutions are used for certain parts of the process. So, for instance, you do have credit rating tools available. Often they can leverage on name recognition because they're made by the main rating agencies. And next to that, and for the market data as well, you have some add-ons for market data. But there it's often incomplete, and it does not really easily facilitate a granular comparability analysis. And then finally, what we also see are Excel models. These are then either developed in-house or externally. But the disadvantage of those is, of course, that they're often error-prone and that they also require manual updates when there's any external changes.
And what are the most common challenges that corporates are facing when they have to determine the interest rates on intercompany loan?
Well, in general, we see really three main challenges. So the first one is determining a borrower-specific credit rating for the subsidiaries. Second one is determining a arm's length interest rate on a loan-specific basis, so on a transactional basis. And then thirdly, it's developing documentation for each and every transaction. So if we go into a bit more detail on those three, so the first one is the borrower-specific credit ratings. Both Stefan and Barry already went into quite a lot of detail on this, so I will keep it high level. But what we in general see a lot is that black box tools are often used. So there the disadvantage is that tax authorities don't like it when you just enter some financials, a rating comes out and there's no real substantiation of it. And in addition, for those types of tools, often only quantitative elements are taken into account, while tax authorities also prefer to have qualitative elements. And next to that, then you also see, for instance, Excel models that are based often on papers issued by the main rating agencies. And then finally, what we also see is rating groups, whereby companies really put their subsidiaries into specific groups depending on how they correspond. And then, for instance, say, well, that group will have the group rating -1 notch, that group will have group rating -2 notches, and so on. But so, as already detailed beforehand, the ideal analysis, of course, takes into account quantitative, qualitative elements, and that group support analysis that has been talked about already. If we then go into a bit more detail on those loan-specific interest rates, so what we see a lot there is that companies use either rating grids with spreads that are updated on a yearly basis. So what I mean with that is then you have, for instance, an Excel grid whereby you have the maturities on one line and the different ratings on the other, and then it details which spread should be used for each and every one of them. Or, for instance, using the external cost of financing. And next to that, also what we see is being data provider curves that are used, so not actual transactions, but just the curves. And then lastly, bank quotes. So those approaches are often used to keep the process manageable for corporates, but the downside of it is that they're no longer accepted, really, and especially on the bank quotes, that has been really explicitly stated in the OECD documents that those cannot be used, and that's because the OECD says it's not an actual transaction. So in order to really be fully compliant, the analysis should be made on a transactional basis, so for each separate loan based on its terms and conditions. And the financial data, both of the entity but also market data that is used to price loan, needs to be taken into account at the moment that the loan is issued, or at least close to it. And then finally, you need actual transactions. Usually bonds are used in the secondary market. They need to be used as a benchmark, and also an interquartile range needs to be calculated on those. The final element then is the documentation. So what we hear sometimes from corporates is, well, we do have some documentation in place, but of course the tax audit comes 3 years after the loan was issued. Maybe the people that priced the loan are no longer with the organization. We do have some screenshots, but it's not really detailed. We see that we made assumptions, but we don't know anymore why. And so to be fully compliant there, a proper reporting really needs to be in place at detailing that credit rating and that pricing analysis. And that, of course, can be a very burdensome process.
Thank you, Melanie. Before we go to continue, first have a look at the outcome of our poll question to see at what stage our audience is. The question was, do you have an automated process in place to efficiently price and document financial transactions? 22% of our audience says yes, we have the end-to-end solution. 34% is having tooling in place, but it still requires manual work. And 44% is saying no tooling in place yet. Are you surprised by this outcome? Do you recognize this?
No, so I'm definitely not surprised. That's exactly as I would have expected. Yeah.
Okay, thanks.
Okay. As Barry mentioned previously, Zanders has developed a tool to price loans. And Melanie has prepared a demo, which we will show you now, how you can assess those 3 challenges that Melanie just commented on.
The cash pool pricing solution enables corporates to set arm's-length interest rates for their cash pools and in-house bank structures. On the left in the solution, you can see the data that needs to be set up before you can make a calculation. In a first step, information on the entities that form part of the pool needs to be set up. In a second step, information on the accounts, such as their historical balances, needs to be added. This can be easily done using the account template. Finally, general information on the cash pool itself needs to be added. In this step, you can also have a view on potential structural balances within the pool. This will enable you to make a decision on if some carry too much tax risk and if you would like to requalify them. Once the data is set up, you can make your calculation. As from this point on, there's very little input still required from the user. You need to select the pool and the data you want to use for your calculation. The solution then automatically determines a rating for all of your entities, as well as standalone withdrawal and deposit margins for the accounts. This data is used to determine the synergies that are generated on a daily basis in the pool. As the synergies have been calculated, they can now be allocated. Firstly, towards the treasury or leader based on the functional analysis. Afterwards, the remainder of the synergies will be allocated to the participants based on an allocation key. Finally, the solution will determine a synergy margin as well as absolute synergy amount that should be allocated towards your subsidiaries. The synergy margin enables you to better the rates that the subsidiaries get so as to let the entire synergy amount flow back towards them. Finally, there's also a substantial transfer pricing report that's automatically generated by the tool. This report includes both information on the specific calculation as well as a full understanding of the methodology.
Well, that was an interesting, insightful demo. Thank you, Melanie. Melanie, up till now we have mainly discussed standalone transactions. But what about pool transactions? As Adriaan and Stefan also indicated, they also have specific transfer pricing implications.
Yeah, maybe good to note that I think the demos were switched around. So we just had the one for cash pools, but I guess the one for loans will come later on then. But so to go more into detail on your question, Laurette. So maybe good to note at first, before we go more into detail on that, what we mean with pooled positions. So actually we mean intercompany balances that are generated by cash management techniques or through cash management techniques. So this can include both really the cash pool positions that are often with an external bank, sometimes in the in-house bank, but also operational positions, such as payments on behalf, collections on behalf, intercompany netting, and so on. If we then go into more detail on the three main challenges we see there. So firstly, we have the functional analysis of the cash pool leader or treasury. Secondly, we have determining and allocating the pooling benefits or synergies. And then finally, we also have the structural balances analysis. So if we go into more detail on the first one, the functional analysis of the cash pool leader and treasury. Again, Adriaan already went into quite a lot of detail on this before, so I will keep it more high level. He presented those two extreme cases on the left and right. Often what we see, though, our corporates fall somewhere in between those models. And so it's really not an exact science, and that's why it's very important to have strong documentation in place, because that, of course, improves your position towards the tax authorities. And why this functional analysis is so important in relation to this is because it, of course, determines the amount of synergies or benefits that are generated by the pool, which can remain with Treasury or the cash pool leader. If we go into more detail on determining and allocating the pooling benefits, then I would say this is probably, when it comes to pooling transfer pricing, the most time-consuming challenge. And especially the more complexer the structure becomes. So if there's a lot of overlay pools, if there's both cash pool positions and operational positions, a high number of participants, maybe currencies, this, of course, makes the situation even more difficult and burdensome. And there it's also important to note maybe that there's two benefits that can be derived. So on the one hand, we have the netting benefit or netting synergy. This comes really from offsetting balances against each other and only needing to go for external funding for the net amount. But on the other hand, you also have an interest benefit. This comes more from the fact that Treasury usually has better conditions in place than the standalone entities would have. And then finally, once those synergies are determined, of course, they also need to be allocated first then based on the functional analysis towards the leader, and then the remainder needs to flow towards the participants using some sort of an allocation key. Finally, what we also have is the structural balances. Here, what we mean with that is positions that have been in the pool for for a longer term, so to say. And this is often an easy target for tax authorities. So we see a lot of for clients that the top part, so to say, of the balance is actually fluctuating like a pool should, but that there's a structural part in the bottom, and that could, of course, be reclassified into a longer term position, which would, of course, also entail higher interest rates.
Okay, thank you, Melanie. Thank you for outlining these challenges related to cash pools. I think we already saw the demo, of course, which we prepared. So I would propose that we now look at the other demo related to intercompany loans.
Let me show you how easy it can be to price your intercompany transaction at arm's length. In our solution, there are 6 steps you need to run through before you can generate your transfer pricing report at the end. In the first step, general information on the lender and borrower is required. In a second step, you can add the terms and conditions of the transaction you are trying to price. In the third step, financial information on the borrowing entity is required for the quantitative analysis of the credit rating. In the fourth step, some qualitative variables first still need to be provided before the solution can determine the standalone borrower rating. Afterwards, a group support assessment is made. This assessment can account both for explicit and implicit support to arrive at a final borrower rating. Once all of that information is established, the solution can determine the arm's length interest rate. This is built up out of a reference rate, a credit risk premium, and a sovereign risk premium. Additionally, the solution also provides an interquartile range of the 30 most comparable transactions. On the next page, more information on those transactions is provided. Finally, an executive dashboard can be found with an overview of the full transaction. Here you can also generate a transfer pricing report. This report consists of both all of the information that the user uploaded to the system, as well as the information that the system gave back. It is a fully substantiated document that details all of the steps in the analysis. And that is how easy it can be to be compliant.
Thank you very much for your contribution. I think this is also a very good time to start with our Q&A. So that's also a question to the audience. If you have questions, please submit them right now.
Yes. And we already have a first question that came in. And Melanie, you can stay because the first question is for you. What should a corporate do if they haven't done the documentation properly for already existing loans?
In general, of course, ideally you do that beforehand. Of course, if the documentation is not yet in place, that can happen. It happens quite often. Then it's still worthwhile to prepare the analysis right now, just so you're prepared. When you're doing that, it's also important to not exhibit what they call foresight, so to say. So you really need to make your analysis as if the pricing was done at the start of the loan. So with that, I mean, you should use the financials of your subsidiary at that time, so for your rating analysis, but also, for instance, the market data at that time. In addition, for instance, doing that analysis can also be purposeful if you would change to a new process throughout it. So then you can always see what would the impact be if I look at some older loans, so to say.
All right, thank you. We have another question coming in. I think, Melanie, that's also for you. Is country risk to be considered in pricing?
Well, we definitely consider it, and I would say so because there's always a certain funding risk depending on which country you're issuing your loan to. So, for instance, take the Eurozone. The reference rate would be the same for each and every country, so to say, if you issue a loan in euro. But of course, maybe Spain or Italy may be a bit more risky than, for instance, Germany or the Netherlands. So in that aspect, yes. The question is then, how will you reflect it? So you can reflect it in your credit rating of the entity. You could also reflect it in your pricing, or maybe even a little bit of both.
Okay, thank you. Next question, I don't know if for Melanie or for Adriaan and Stefan, but the question is for a lot of, what to do when the base rate is negative, for example, Euribor. Are tax authorities scrutinizing this? Is it for you, or do we say Adriaan, Stefan? Who would like
I can take it, no
Perfect.
problem. So what we always advise clients to do is to see what their conditions on their own external pricing. Because of course, if the bank still floors your rates, sometimes that's still the case, then it will be difficult to defend using negative rates internally. On the other hand, if the bank doesn't floor your rates anymore, then normally it should be defendable to apply negative interest rates. But of course, it can still trigger scrutiny. But on the other hand, it's also not, Treasury shouldn't be making a loss, of course.
Okay.
All right. Thank you very much, Melanie. I think we have only a few minutes to go before it's 12 o'clock. So this hour is running really fast. I think I would first of all like to thank you all for your valuable insights, which you gave today from both Laurette and from myself. I think what's important also from my side is that for me, the key takeaways of these sessions are really to refresh your transfer pricing policy and also include, let's say, your short-term cash pool facility in it. That is important that when setting up new intercompany loans to involve both tax and treasury. The third element, which for me is the key takeaway, is that the tax authorities look at three main components, being the business rationale of the loan, the terms and conditions, and of the substance requirement. And for cash pools, it's very important that you perform a functional analysis, that you allocate the benefits correctly, and that you identify the structural balances within your cash pool. And I think the most important one, which I heard you also saying, Melanie, is it's all about documenting and monitoring your intercompany loans.
Be prepared for
prepared,
discussions. We've come to an end. We hope you enjoyed our webinar. We will also send you a link where you can review the webcast. If you have any additional questions, please don't hesitate to contact us and we will come back to you. And then I would say, enjoy your day.
Enjoy your day. Thank you very much.